Hi there. Good evening. I hope you're well. Just a quick notice to let you know that the next PowerPoint, narrated PowerPoint, is going to be on demand side policies. It's based on a new booklet, CC13, which is fiscal policy and supply side policies. And what we're going to cover today is the first of probably 4 or 5 PowerPoints on this booklet. It's a reasonably chunky booklet, which I think I mentioned to you on Friday. But we're going to be going through demand side policy, specifically government spending and fiscal policy on this particular PowerPoint. So without further ado, we'll get cracking. So first things first, then we're going to be looking at, as I mentioned, fiscal policy in particular. This particular CC13 covers a few things. It covers fiscal policy. It covers both demand and both fiscal and monetary policy responses to the Great Depression, as an example that you could maybe apply in answers or whatever. Then we're going to look at supply side policies in a bit more detail, and then also look at some of the conflicts that a government might face between its macroeconomic objectives and trying to achieve those conflicting objectives. So that's the plan for 4, maybe 5 PowerPoints that we're going to be doing over the next week or so, week and a half, I would think. Okay, so that's the plan. Okay, so what you're going to need to know then, this is straight from the specification, it is quite a chunky amount of items that are covered in there, in what you need to know, but they all sort of link together reasonably closely. So first things first, then fiscal policy, that it involves the manipulation of government spending, taxation and the budget balance. So that's something that you will hopefully be familiar with, but obviously I know you only touched on it briefly in year 12, so we'll go into that in a bit more detail. The fact that we can use fiscal policy for both macro and microeconomic functions, and we'll look at the difference between the two. How fiscal policy can be used to influence aggregate demand. So we're starting to look not just at how policy might change an individual firm's demand, but also aggregate demand overall, and also how it might be able to be used to influence aggregate supply. Next thing that we'll need to be aware of is how government spending and taxation can affect the pattern of economic activity. The types and reasons for public expenditure, why governments have to levy taxes, and obviously if you've done anything on fiscal policy, you'll be aware of why that is the case, but we'll look at that in a bit more detail. Difference between direct and indirect taxes, and then the difference between progressive, proportional and regressive taxes, which you hopefully will be reasonably familiar with, but again, we'll look at that in a wee bit more detail. We'll also look at the principles of taxation, such as that taxes should be equitable, and look at the 4 canons of taxation that Adam Smith came up with, and that still hold good now. The roles and relative merits of different UK taxes we'll look at, and also the relationship between the budget balance and the national debt. And it's quite an important distinction, that difference between the budget deficit and the national debt. Okay. We'll also look at cyclical and structural budget deficits and surpluses, and how those might be affected by fiscal policy, and then also the consequences of budget deficits and surpluses. Surplus, easy for you to say. So easy for me to say. Surpluses, sorry, for macroeconomic performance. And then finally, the size and significance of the national debt. And in addition to that, we'll look at the role of the Office for Budget Responsibility, which essentially that's the office that is responsible for putting together all the budget figures, and then sort of reporting on them. And then you will need to be able to access or assess, the economic significance of changes in the level and distribution of both public expenditure and taxation. And also be able to discuss the issue of the budget balance and be able to evaluate the possible economic consequences of a government running a budget deficit or a budget surplus. So that covers what we'll need to know. Sorry, there's one more to cover too. And that is you should be able to assess the impact of the measures used to rebalance the budget. So those are the key items. Sounds like a lot, but there's quite a lot of crossover in each of those areas. So let's move on and take a look at each one in a bit more detail. Then let's take a look at some definitions in the first instance then. What is fiscal policy? Basically, it's the manipulation of government spending and taxation to affect aggregate demand and achieve macroeconomic objectives. So if you can remember the principle of government spending and taxation, whenever you think about fiscal policy, those are the basic things that the government can use in fiscal policy to have an effect on aggregate demand, and as a result of that, the way in which they can try to influence the way the economy might move forward in the future. The budget, you'll be familiar with the budget, which is obviously something that the Chancellor issues each year, the annual statement of planned spending and tax revenue, which fundamentally is looking at how, number one, the government's going to raise the money to actually run the economy, and also where it's going to spend that money. That's fundamentally what the budget is. Okay. Now, again, we'll come back to this on numerous occasions during this presentation, particularly fiscal budget deficit and also a surplus. Okay, so a fiscal budget deficit is basically when the government is spending in excess of what it's raising in tax revenue. Okay, now if we have a budget surplus, fiscal budget surplus, then effectively the tax revenue that we're gathering as a government is actually exceeding the amount that we're spending. Okay, so those are two things to bear in mind. And also we need to think about the reasons why we might do each one of those as a government. Okay. We obviously mentioned taxation as a fundamental part of fiscal policy, so we'll need to understand the difference between direct taxes and indirect taxes. Direct taxes are those that are actually levied directly on income, wealth and profit. So for instance, income tax, national insurance, capital gains tax and corporation tax. And then an indirect tax is that those taxes that are actually levied on spending by consumers on goods and services, like VAT or specific taxes on fuel and alcohol or car tax. Okay, so those are some definitions that we'll need to keep coming back to and keep referring back to through the course of understanding a wee bit more about fiscal policy in particular. Okay, all of these chaps that you can see in the picture have all got something in common. They've all held the office of the Chancellor. Obviously, we've got the current Chancellor, Rishi Sunak. We've got the previous Chancellor, George Osborne. We've then got Philip Hammond, who was briefly Chancellor, and also Alistair Darling, who was the last Labour Chancellor. So in terms of what they're doing in this instance, okay, and what the government is doing in this instance, what fiscal policy attempts to do is to influence both macroeconomic activity by changing levels of aggregate demand in an economy, but also, in some cases, it will have microeconomic functions. Okay, something that's not often talked about, but actually they can be used. So fiscal policy can be used to make markets more flexible and dynamic, and that's by using obviously taxation as an option and the way in which you might choose to tax certain businesses, etc., but also subsidies of some description to try to influence both consumer behaviour and also to a degree affect the income tax and the welfare system to provide incentives in the labour market. So effectively we can have both macroeconomic fiscal policy, but also we can use it to affect micro, the economics of a firm or a particular industry. So let's take a look then at, so we've looked at page 1, 2 and 3, and within page 3 there is also a little bit more detail which explains some of the reasons why a government is using the different types of fiscal policy, from expansionary to contractionary, and also bearing in mind that the effect that the change in expenditure might have is very much dependent on the level of the multiplier. But again, that's something we'll come back to look at a wee bit later. So in this instance then, let's take a look at on page 4, there is a couple of little activities for you to do, and this is where we're starting to look at how government changes or changes in government taxes and spending are going to affect the economy, specifically using the circular flow of income model. Okay, so obviously that's bearing in mind aggregate demand, but also things that add to the circular flow and those that remove from the circular flow. So that's something to bear in mind. Okay, so first things first then, if we're talking about government spending, that is going to represent something into the circular flow of income, and in this instance it would be an injection into the circular flow. So government spending is essentially an injection into the circular flow. It's going to increase the amount of money or resources put into the circular flow of income within an economy. We then look at taxation. That obviously is a leakage from the circular flow of income. So any taxation that's taken out of people's pockets, essentially through income tax or corporation tax, is essentially a form of leakage or withdrawal from the circular flow of income. So that's something worth bearing in mind. So in essence, when we're talking about fiscal policy, some elements of fiscal policy are about injecting money into circular flow, and others in some cases may be taking money out of the circular flow. And so if we have a budget deficit, if we're talking about a budget deficit, a fiscal budget deficit, that's going to cause a net injection into the circular flow of income. So in that instance, what we're saying is if we have a budget deficit, in that situation, we have actually gathered less tax than we've actually put into the system. Okay, so in terms of government spending. So if we have a budget deficit where essentially we've gathered less tax than we've spent, that actually represents an injection into the circular flow. If we've got a budget surplus, so in that situation we've gathered more tax, we've gained more tax than we've actually spent, then that effectively would be a leakage or a withdrawal from the circular flow, because we've gathered more revenue via the tax system, but in this instance we've chosen, maybe for good reason, not to spend it all. Okay. Now, obviously, there's then an example of the circular flow of income diagram. This is probably slightly more detailed than some of those that you've done or looked at before. You do need to be familiar with that circular flow of income, and essentially what we're saying is that, just as a bit of revision, we've got factors of production who are actually bringing together, in this instance, or businesses bringing together factors of production, producing goods and services for households, and basically we're then exchanging, in this case, money and resources for those goods and services. And that fundamentally, although in this instance it's a little bit more complicated than that, that's the fundamental principle. So the circular flow of income is a really important concept for you to get your heads around. Okay, let's take a look then in a bit more detail then at public expenditure and taxation then, particularly taxation. So in essence, what we're doing is saying that to gain revenue, the government has to actually, to finance its expenses, it clearly has to gain some revenue from somewhere. And in this instance, taxation, both direct and indirect, is what is used to raise the money available for the government to spend on the various different things that it sees as being most important. Okay, so there are two types of taxation, as we mentioned before. One is direct taxation, one is indirect taxation. And there is a chart on page 5 in your booklet, so I'd like you to have a go at completing. If you need any help, if you take a look on page 459 through to 469 of Powell, there is a detailed explanation of the tax system in the UK and the different types of taxes that are available. So I'd like to go away and have a think about that, do a bit of research on that, and then obviously come back to the presentation, and we'll then talk about the different forms of both direct and indirect taxation. So if you'd like to pause the presentation at this point, go and do a bit of research, and then obviously come back to the presentation as it suits you. There is a video clip that I'd like to take a look at as well, which is on the PowerPoint. What I've done is I've actually included both the CC12 booklet and also the first of these PowerPoints, the one that we're going through right now, on Teams. So if you need to go and take a look at the main presentation and to be able to get hold of and go and visit the links, then obviously you can open that in PowerPoint, make sure you've got it on the slideshow presentation, and those links should work for you. Okay, so although I'm referring to them and I can click on that and show it you here and now, then obviously if you want to do that in your own time, that's the way to access it. Okay, so examples then of direct taxes and indirect taxes. First we'll look at direct taxes then. Okay, we've got income tax. Okay, so fundamentally anybody who works for anybody will be paying income tax at source, PAYE, pay as you earn, and that income tax goes direct to the government. There's corporation tax. Okay, so if you own your own business, then fundamentally you will pay corporation tax on any profits that you made. Once you've considered all your costs and any arrangements that you might have with the taxman, etc., then once you've calculated that, you will have to pay, I think it's 19% of any profit that you make goes to the government in the form of corporation tax. There is capital gains tax as well. So if you make a profit on selling an asset such as shares or property, there is a capital gains tax that you again would pay to the government, and that would be a direct tax on, in this case, profit or the gains that you made from owning a particular asset of some description. Okay, national insurance is another direct tax. Again, that's paid at source. If you are an employee or an employer, then the employer pays an amount of national insurance on each employee's behalf, and obviously the employee does the same too. We've got indirect taxes as well. So this is taxes specifically on spending. So we've got VAT, which is obviously the one that most of us are aware of, value-added tax. Also excise duty on things like alcohol, tobacco and fuel. And then there is also stamp duty, which again is levied on any house purchase that somebody is planning to make. As it's mentioned there, so any tax that you pay, or you pay a tax when you're purchasing a new property once you reach a certain value in terms of the property that you're buying. There's a short video. It's about a 2 or 3 minute video that I'd like you to take a look at, called "The Regressive Nature of Indirect Taxation," and that spells out in a wee bit more detail in quite a graphic way this principle of indirect taxation being slightly unfair in one sense, in that it actually takes a high proportion of disposable income away from those people who are relatively poor in comparison to those that have more money and would be classed as richer. Okay, so that's worth taking a look at, and again, it gives you quite a nice insight, graphic insight into how that presents itself. The other things I want you to just take a quick look at on page 6 in your booklet is the difference between progressive, regressive and proportionate taxation. Now, we have talked about this before. Progressive taxation fundamentally is about the principle of it is that as you get richer, then you should be more comfortable with paying more tax. Okay, so fundamentally it's where we're talking about the proportion of income tax being paid rising as income increases. Regressive taxation, which is the principle that you've looked at in the previous video on the syntaxes, is basically where the argument is that the lower paid lose a greater proportion of their income in tax than those that are richer when buying things like cigarettes, alcohol, and also VAT. So where we're talking about a tax on spending. Okay, and then we've got proportional taxation, which is something that does happen. Does happen in a couple of European countries, where fundamentally it's what's known as a flat tax, essentially. So everybody would pay the same percentage of tax on what they earn. Now, some free market economists believe that is a good way of incentivizing people to earn more, and also there's a number of reasons why it's considered to be a good, from a free market perspective, a good option to consider. However, there is an argument to say that should somebody who's earning millions and millions of pounds only be paying the same rate of income tax as ordinary workers, and obviously that's almost a moral and philosophical argument that obviously you need to sort of square away in terms of whether you believe in the free market or not. There are a couple of other things to bear in mind before we move on to look at the composition of UK tax receipts, and that is something that was first suggested by Adam Smith, which is to do with what the taxation system must be. And he came up with four canons of taxation, which basically were that it needs to be economic, i.e. it needs to be cheap and easy to collect in relation to the amount of revenue that it yields. It needs to be convenient, so taxpayers can pay it easily, and that they can see that the reason why the government needs that tax in order to achieve its objectives. It needs to be certain, so that taxpayers know how much they're going to be required to pay. And finally, it needs to be seen as equitable. It needs to be seen as fair and based on the ability for those who are actually being asked to pay it to be able to pay it. Okay, so that's all covered on page 6 in your booklet. Okay, the next thing I want you to take a look at is this chart. Now, again, more often than not, we talked about the fact that interpretations of charts and graphic examples of data are really quite important. So there's a bit of an activity for you here, where you've got on page 7, you've got the composition of UK tax receipts for 2017, 2018, and those have all been broken down for you. Okay. But what I'd like you to have a go at and see if you can come up with identify the top 3 revenue raises or individual taxes for the UK. So again, I'll give you some time to take a look at that, and then there is an extension question for you there. What are the implications that the top 10% of income taxpayers paid 59% of all income tax receipts? Okay, so again, have a go at calculating that. So I turn the presentation off for a bit, and then we'll come back and look at what the responses were in this instance then, okay? So, welcome back. We're looking at the three top revenue raises for individual taxes for the UK. So the first one is income tax at 25% of all tax receipts. The second one is 19% and that's national insurance, and then the third is VAT at 18%. So those top 3 revenue raises, although there's a significant number of other things that essentially those 3 taxes account for 62% of all tax revenue, and so clearly those are the key ones that the government needs to focus on to make sure that they are getting those paid and at the right levels. So thinking about this principle then, and this is something that is quite a not shocking, but a sobering statistic. Government spending takes up to over 40% of GDP in normal circumstances. Now, clearly at the moment, we're talking about a significant percentage higher with the pandemic and all of those things that are going on. But think about in your local town or your local city, the sorts of things that the government is spending money on providing for. So if we take Winchester as an example, we've got Peter Symonds College, which is obviously a significant education institution. We've got the University of Winchester, we've got the Royal County Hospital, we've got lots of infrastructure, we've got the train station, we've got the Winchester School of Art. You can see just by looking at any city or any town, there are significant amounts of government spending being spent on transport, infrastructure, and all of the things that we talked about. So in this case, obviously Winchester's quite famous for obviously its cathedral and a number of other things that are going on. So there's lots of national trust properties and all sorts of other things that again they're being used, or the resources are being used to provide those infrastructure and other items. So I'm quite sure why we've gone to Google Maps. That's my cursor going somewhere it shouldn't have done, so I do apologise for that. So in that instance then, let's take a look at a little bit more detail at government spending then, okay? So there are 3 types of government spending. They are transfer payments, okay? So welfare payments made to benefit recipients such as state pension or job seekers allowance. Now, so this is now moving on to take a look at the information on page 9. So that's the first example. Okay. Then we've got current government spending. So spending that's on state-provided goods and services such as education and health. And finally, the third one is capital spending, where we're talking about infrastructure spending on things like new roads, hospitals, motorways, and prisons. So the taxation is essentially what's raising the revenue for us to be able to use that or the government for them to be able to use that in hopefully some reasonably positive ways. But also we've got to bear in mind a number of other things as we go too. So in essence, we talked about the fact that we spend nearly 40% of GDP on government spending, or governments. So that is a significant amount of money when you think about the level of GDP that we might achieve. And also we need to bear in mind that we've also got this total managed expenditure principle. And again, here's yet another set of graphical information for you to have a look at and assess a number of things. Now, you can see in this instance, and this happens quite a lot in economics charts, we've got two different scales of both. Well, one is percentage of national income, and the other is the number of billions in 2014, 2015 prices. So the TME, the total managed expenditure, is essentially the total amount that the government is spending. And that splits the amounts into those that is spent by government departments, but also those that are not spending that's not controlled by government departments, like welfare, pensions, the national debt, interest payments, etc., etc. So it's a significant amount of money, as you can see. Now, in this instance, then. The question is, how is the government spending changed over this period, both in real terms and also in terms of percentage of GDP? So you'll need to do a few calculations, and again, I'd suggest that you stop the presentation here, have a go at the calculations, and then we'll look at those together in a minute. Okay, so in real terms then, in this instance, we've got 100 billion in 1948-49, roughly speaking, predicted to be 710 billion in 2017-2018. So effectively, during that time, we've got an increase of 610 based on what the original was, timesing that by 100. We've had a 610% increase in real terms in the total managed expenditure for the government. Now, if we look at that as a percentage of GDP, well, we can see that in the first instance we had in 1948 to 49, around about 38% of that figure of the total amount of GDP was the basic number. Now, clearly, when we look at 2008, 2009, that figure went up to around about 48%, predicted to fall back to around about 38% by 2017, 2018. So again, this, as much as anything, is about interpreting charts, and in some cases, some people might find that straightforward, but in other cases, you just need to make sure that you understand why and how to interpret that information from when you're looking at, in this case, both the real terms and percentage of national income that the total managed expenditure takes up. Okay, so let's move on then and take a look at this issue of budget deficits and surpluses. Now, on page 10 in your booklet, there is some information on the government spending when the government spending is greater than tax revenue, and effectively in this situation, if we've got years where government spending is greater than tax revenue, then the government will need to borrow to make up a shortfall, and that is known as a budget deficit, i.e. we haven't gathered enough tax in order to pay for all the things that the government wants to spend money on. Now, in years where we have a situation where the government is spending less than tax revenue, then in that case we have a budget surplus. Now, you'd think that sometimes, more often than not, you think, well, a surplus is normally a good thing, don't you? But in some instances, if you think about this principle, where if the government is spending more than it's gaining in tax revenue, there is an argument to say that although that's known as a budget deficit, that may well be that the government is choosing to try to stimulate the market or the economy in some way in order to encourage economic growth and hopefully an improvement in output and in GDP. Now, again, on page 10, you've got two examples, two pie charts, one which is based on public sector current receipts. So that's clearly, in this case, for 2018, 2019, the amount of money that has been gathered by the government via various different forms of taxation. But then you've also got, in this instance, you've got public sector spending, 2018, 2019. So on the basis of those charts, I want you to do a few calculations. I want you to take a look at the total government revenue that's available, calculate the total government spending, and then is the government in surplus or deficit, and what were the three biggest areas of spending. So again, bit of data interpretation, getting you familiar with that, looking at the pie charts and doing some calculations. So I'll give you a chance to have a look at that, and then I will send you, well, not send you, we'll then discuss the responses to that. So let's take a look then in the first instance then at the total government revenue. Now that fundamentally is just taking the information that's provided in chart 2 of our public sector current receipts and adding them all up. So the current revenue, or the revenue for 2018-2019, was 769 billion. However, total government spending was 808 billion, and that's based on adding up the all of the different parts of the pie chart based on public sector spending. So on that basis, the government, to answer question C, has actually, in this case, got a deficit of 39 billion. So it's basically spending 39 billion pounds more than it's gathered in tax revenue. And then if we take a look at the three biggest areas of spending, they are, in this instance, social protection, health, and education. Okay, so obviously those are the biggest spenders in this instance, and obviously if we added those together we could then calculate that. I haven't been asked to do that as such, you've just been asked to highlight which are the biggest spending areas of those particular situations. Okay, so we talked about surpluses, we talked about budget deficits. It's important that you understand the principle behind those two. And now we're going to come on to look at the national debt. Now, more often than not, people get very confused about deficits and or budget deficits and borrowing deficits and the national debt. Now, the basic difference between the two, we're talking about a budget deficit where effectively the government is having to borrow money in order to finance its spending plans. Then that year on year is basically a budget deficit. Okay, so the budget deficit is what when I say year on year, that's probably confusing you slightly. Basically, if we decided in this year that we were going to spend 20 billion and we only raised 15 in tax revenues, then we would have to borrow 5 billion in order to finance the difference. Okay, so the budget deficit would essentially be financed by borrowing. Now, the national debt is basically the total outstanding debt. So whenever we have a budget deficit year, the national debt would grow. If we had a budget surplus, then the national debt would fall. Okay, that doesn't happen very often, as I'm sure you're aware. But the other thing to bear in mind in this instance is where we've also, on page 11, got yet another graph for you to take a look at. So in this instance, we're talking about the national debt graph. It's also on your on the narrated PowerPoint. So in this instance, we've got, again, two different axes based on two different ways of measurement, and also net debt in blue, net debt as a percentage of GDP as the yellow line, and then also the projection as to where that might go in the future. So in this case, the information was provided for 2013, and then anything that's greyed out in this instance is actually a projection or an extrapolation on the data. Okay, so in this instance then, we've got a graph showing how the national debt has risen since 2003. And I'd like you to describe in both money terms and also as a percentage of GDP how those things have changed. Okay, so again, take a look at the data, do a bit of interpretation, and then obviously interpret that, in this case, into the change in money terms and also in terms of the percentage of GDP. And if you calculate that using the data, and then obviously you can give that some thought and fill that in your booklet on page 11. Okay, let's take a look then at fiscal policy and some of the resources that you can take a look at, which again, rather than just listening to me, might actually make it slightly more engaging, slightly more interesting. It's quite a nice video clip on the government debt and the deficit explained with coloured sweets. So it's only about 3 or 4 minute video, but it's quite a nice graphic example of how the government deficits build up and how that then adds to the national debt. There is also a good website showing UK government debt that you can take a look at by clicking on that link, and also the importance of bonds and why they matter. And that again is something that when we're talking about government having to borrow money, the use of bonds and gilts are a fundamental part of that, and that obviously links into fiscal policy too. Okay, so if we take a look on the bottom of page 11, we've got some information on how government spending fits in and works through with aggregate demand. I'm sure you're all familiar with the formula: aggregate demand being consumption plus investment plus government spending plus the difference in net trade, so exports minus imports. Okay, so government spending is a very big component of AD, of aggregate demand. Okay. So in that situation, if we have a rise in government spending, that is going to lead to a rise in aggregate demand and hopefully a subsequent increase in national income. If we've got a fall in taxes, so remember that we're talking about both government spending and taxation. If we have a fall in taxes, then that's going to cause a rise in disposable income. And then that should then, if we've got more pounds in our pockets as consumers, that should cause lead to a rise in consumer spending. That's clearly going to depend on the multiplier effect. And the multiplier effect on national income of government spending should actually be quite significant, provided we're not at full capacity in terms of the economic ability to produce goods and services, etc. Now, if we then take a look at other things to bear in mind too, if we're talking about expansionary fiscal policy, that hopefully is going to also cause a fall in unemployment, because if we're expanding the economy, new jobs should be created in the public sector, and the rising spending should mean more demand for private sector goods too. And so there should also be an increase in new jobs in the private sector. However, if we chose to go down a contractionary fiscal policy route, that would essentially either be a fall in the government spending or a rise in tax, or maybe in order to try to cut the budget deficit. That is likely to cause aggregate demand to fall. If that happens, then there's a possibility we might have a national income falling, and that could have a negative multiplier effect. And clearly, if we go too far and contract the economy too far, that could also mean that output would be reduced. Firms might actually choose to shut down, or also streamline their workforce, and so maybe cause job losses. Okay, so there's some significant principles to bear in mind there. Okay, now the other thing to bear in mind is that the different types of budget deficit can be caused by two different things. One can be cyclical budget deficits, where we're essentially going through the economic cycle, and the upswings and downswings of the economic cycle will cause, in some cases, some cyclical budgetary deficits. However, there are also other things to bear in mind, like structural budget deficits, where we're talking about not things that are affected by the economic cycle, but structural changes in the economy that obviously can affect government finances, and also in some cases cause long-term government policy decisions to change. Now, one of the things to bear in mind is that whenever we have any significant shift in economic activity and aggregate demand changing, so if we've got economic cycle changes, there are things in place that have been put in place by government known as automatic stabilisers, and they are designed to, they are fiscal policy instruments like progressive taxes and income-related welfare benefits that try to either stimulate aggregate demand automatically in an economic downswing, but also to depress demand when there is an upswing. So trying to smooth the economic cycle out effectively. And it's about the automatic stabilisers are trying to provide some sort of stability and also reduce the volatility of the economic cycle. So that's something to bear in mind too, okay? Okay, so we've covered a significant amount of information already there, but we're going to just take a look at a few questions now on fiscal policy, and then we will stop, okay? So there are, I think, 5 or 6 questions that I'd like you to give some thought to. So what I'd suggest you do is, again, do each one step by step, and then obviously stop the presentation, and then we can take a look at the responses as a result. Okay, so first one then, use diagrams below to show the effect on the economy, both in terms of real output and price level of expansionary and contractionary fiscal policy. So let's take a look at expansionary policy in the first instance. Okay, so in this instance, we're obviously I've got 2 axes. We've got real GDP along the horizontal axis, and the vertical axis is price level. So if we're expanding, or got expansionary fiscal policy, then the hope would be that aggregate demand would move from AD to AD1. And in this instance, clearly, output would move from Y to Y1, and our price, the price that we're charging, or the price of goods is also going to increase because of that extra aggregate demand. Now, you'll also see, we'll look at long-run aggregate supply and the Keynesian view on that, and also the classical view on that in a later video. But effectively, in this instance, where we've got output at full employment, that is also shown, and effectively, once we get to that point, if we're at full capacity, any increase in aggregate demand is basically going to be inflationary, okay? Let's then take a look at contractionary fiscal policy. Well, in essence, that's the opposite, isn't it? We've still got the point at which full employment, output of full employment is shown with the red line, but in this instance, we've got a shift from AD to AD1. So effectively, demand has been reduced based on government spending and or taxation changing, levels changing. And we've got a move, in this case, from P to P1, where the price has fallen. So in this instance, we might be using fiscal policy to help to dampen the economy to some degree. When we're talking about expansionary fiscal policy, this is about trying to encourage more demand to fuel, hopefully, economic growth and real GDP growth. So let's have a look at the second question then. In the short run, a fall in the budget deficit is most likely to increase what? So a fall in the budget deficit is most likely to increase unemployment. Okay, so a fall in the budget deficit means that effectively we're gathering more tax and spending less, and so effectively one could argue that is basically going to contract the economy to some degree, and so in that instance, that's something that would cause an increase in unemployment. If we take a look at question 3, the government is wishing to reduce the level of unemployment through the use of fiscal policy, would be most likely to, well, it wouldn't be lowering interest rates because that's monetary policy, decrease the size of the budget surplus. That's one that we could bear. Increasing interest rates, again, that is not going to be have an effect on fiscal policy, because in this instance, that's actually monetary policy. So in this instance, the answer would be B, where we're talking about a decrease in the size of the budget surplus. Okay, so if we wanted to reduce the level of unemployment, we would essentially be attempting to expand the economy. And clearly, if we decrease the size of the budget surplus, so a budget surplus is where we're spending less than we've gathered, that obviously would have had the effect, hopefully, of stimulating more employment. Let's take a look at question number 4 then. So in this instance, which one of these is an example of fiscal policy? Government decision to decrease the exchange rate. Well, exchange rates, as if you can remember from the previous presentations that you've done, basically is a monetary policy tool. So it's clearly not an example of fiscal policy. What about raising the minimum wage then? Is that a possibility? Could be a possibility. What about increasing its budgetary surplus? That could also be potential budget surplus potentially fiscal policy. What about reducing the interest rate? Well, in that case, no, we know it's not going to be because that's monetary policy. So in this instance, if we're talking about raising the minimum wage, it's not directly fiscal policy. That is actually a supply side policy, as we'll see. But in this instance, the answer, question 4, would be C, increasing the budget surplus. Okay, that's, remember, the difference between government spending and taxation. Let's take a look at question 5 then. So in this instance, which one of the following fiscal policy measures would be most likely to reduce aggregate demand? And in this instance, that would be reducing state retirement pensions and leaving taxation unchanged. Okay, so with so if we're talking about fiscal policies that would most likely reduce aggregate demand, they clearly would do that, wouldn't they? So state retirement pensions reducing and leaving taxation unchanged would clearly be a way of reducing aggregate demand. Some of the other things that are included would actually stimulate more rather than reduce. Look at question 6. In which one of the following situations is the government most likely to pursue an expansionary fiscal policy in order to increase aggregate demand? In this instance, the answer would be cyclical unemployment is increasing. So if that were the case, we would want the government should be looking to expand to use expansionary fiscal policy in an attempt to try to reduce cyclical unemployment. And then if we take a look at question number 7, and then we'll stop. In the short term, contractionary fiscal policy is most likely to cause what? So if we're contracting contractionary fiscal policy is basically going to reduce the amount of spending in the economy. So in this instance, what is it most likely to cause of those 4? It's actually going to be B, where if we're contracting, trying to take the heat out of the economy, then the chances are that it's most likely to cause contraction with fiscal policy of those things is most likely to cause a rise in unemployment. Okay, so we've looked at some short questions, some multi-choice questions. Just to finish off, just go through 4 evaluative questions or statements that are on page 16 in your booklet, and also draw your attention to the Powell chapter, which covers fiscal policy and also supply side policies, in page 448 through to 490 in your booklet. Now, there are 4 questions that, again, I want you to give some thought to. I'd like you to stop the presentation once we've actually gone through each one, and then have a go at answering those questions. Okay, so how will the effectiveness of fiscal policy depend on the size of the multiplier, as the first question? How will the effectiveness of fiscal policy depend on the amount of spare capacity in the economy? And you could use a diagram to demonstrate that. How will the impact of fiscal policy changes depend upon the private sector investment and consumption? And finally, what are the costs to the government of using expansionary fiscal policy to reduce unemployment? So 4 questions that you might need to take a look at the notes that you've got already on fiscal policy, and also take a look at the previous notes in the course companion, plus obviously the reference that I made to Powell for pages 448 to 490. Okay, I'll give you a chance. I'd suggest you stop the video there, have a go at completing those answers, and then we can take a look at those together. So I'll speak to you shortly about that. Okay, so how will the effectiveness of fiscal policy depend on the size of the multiplier then as an evaluative question? Well, clearly, in this instance, we're talking about fiscal policy being much more effective when you've got a large multiplier effect. So if there is a large multiplier effect, the rise in government spending will cause a greater eventual rise in government spending and activity within the economy if there's a larger multiplier effect. Okay, so second question, how will the effectiveness of fiscal policy depend on the amount of spare capacity in the economy? Let's take a look at this then. So if we've got lots of spare capacity in the economy, and this is something that we'll look at in a bit more detail in the next but one presentation, where we look at the difference between the classical and the Keynesian view of supply and demand. But if we assume that we've got lots of spare capacity, so we're on a relatively flat section on the AS curve, where that means that we've essentially got some spare capacity, then the rise in government spending and aggregate demand will cause a relatively large rise in GDP or economic growth, and a relatively small rise in the price level or inflation, because clearly if we've got extra capacity, we may not need to employ more people, wage bills may stay the same. So in that situation, we may well find that to be a very effective way of trying to stimulate extra economic growth and development. However, the opposite is very much true if we have a rise in the government spending, and that causes a rise along to the steeper or inelastic section of the AS curve where we're reaching somewhere near full capacity. Then clearly adding more fuel to the fire through fiscal policy that's expansionary, that could actually cause inflationary pressures as a result, and that's something that we'll look at, as I mentioned, in future presentations over the next sort of couple of presentations. If we take a look at the third question then, how will the impact of fiscal policy changes depend on private sector investment and consumption? So if we get a rise in government spending, that may not necessarily cause a rise in aggregate demand, particularly if consumption and investment are falling. So that's going to have stuff to do with confidence, consumer confidence, and also business confidence. So clearly, if we've got high levels of animal spirits, then we're likely to get high levels of investment and also consumption. But if that, for whatever reason, we've got a lack of stability, or there's a lack of confidence in where the economy is going to go next, that clearly can have an impact on the success of fiscal policy changes. And then finally, what are the costs to the government of using expansionary fiscal policy to reduce unemployment? So this is where we're starting to look at, and obviously as we go through these next couple of sets of activities that we'll look at, we're going to be looking more and more at the conflict and trade-offs between the government using certain types of policy to try to achieve one objective and how that might affect or conflict with another. So in this instance, if we've got expansionary fiscal policy going on, then in that situation, that obviously could raise, that could be, it's going to be a case where the government will be raising its spending and lowering its taxes. That's going to potentially lead to a higher budget deficit and also a higher national debt, which clearly at some stage has to be paid back. It's also an argument to say that in this situation, if we've got expansionary fiscal policy, so we've got more government spending and lowering taxes, then there is a danger that if we're at the point of somewhere near full capacity in the economy, then we're going to get demand pull inflation, because as AD rises along to the inelastic section of the AS curve, where we're talking about full employment or relatively close to full capacity, that is going to create demand pull inflationary pressures, and clearly that might well be, well, definitely is a government and a Bank of England's target to try to control inflation. So in some instances, whilst expansionary fiscal policy could and should reduce unemployment, there is a danger that in certain situations it could also stimulate greater inflation. Okay, so thank you for listening. I know that went on for a little while, but hopefully that made some sense to you, and I look forward to catching up with you soon on the next presentation. So cheers, bye.